Friends, understand one thing. Most day trading is not investing. It is a gambling subculture built around the illusion that the future can be predicted. If you want to make money, or more importantly, if you want to avoid losing it, then listen carefully, because almost everything you've been taught about markets starts with the wrong question. Most people lose money in the markets for the same reason most businesses fail. Not because they're stupid, not because they're unlucky, and not because they lack information. They fail because they're trying to solve the wrong problem. They spend years searching for the perfect prediction, the perfect indicator, the secret pattern, the hidden signal nobody else has found. Meanwhile, the people who consistently make money are often doing something much simpler. They're not trying to predict the future. They're trying to structure their business so that they don't need to. And once you understand that distinction, almost everything you've been taught about trading starts to look backwards. So in this video, I want to show you a much more practical way to think about markets. Not as a puzzle to solve, not as a forecasting contest, but as a business. Because the moment you start thinking like a business owner instead of a gambler, everything changes. Human beings love stories. We love explanations. We love the feeling that we understand what's happening. Unfortunately, markets don't care. The market is one of the most competitive environments ever created. Every day, millions of intelligent people are trying to predict the same thing you are. Many of them have better data, better technology, more experience, more capital, and entire teams of specialists. Yet beginners often enter this environment convinced that they're one chart pattern away from unlocking a secret. Think about how strange that is. Nobody opens a restaurant and assumes they'll immediately outcompete every restaurant in town. Nobody starts a law firm and expects to beat the best attorneys in the country on day one. Yet people regularly open a brokerage account and assume they'll outsmart a global network of professionals. That isn't confidence. It's a misunderstanding of the game. The market is not waiting for you to discover a secret. The market is waiting for you to make a mistake. And the most common mistake is believing that prediction is where the money comes from. It usually isn't. Every successful business can answer one simple question: why do I deserve to make money? That question sounds obvious, yet most traders never ask it. Instead, they ask, what indicator should I use? What stock should I buy? What chart pattern works best? Those are secondary questions. The primary question is, why should money flow to me instead of somebody else? Imagine a business owner who can't answer that. You wouldn't invest in the business. You wouldn't lend them money. You probably wouldn't even work for them. Yet many people trade for years without ever developing a clear answer. A business exists because it provides something useful. It solves a problem, it absorbs a risk, it creates convenience, it performs a service. If you're going to make money in markets, the same principle applies. You must understand what value you're providing, and more importantly, why somebody on the other side of the trade is willing to accept a worse deal than you are. At the most basic level, every trading strategy comes down to a simple idea: buy something for less than it's worth, sell something for more than it's worth. That sounds obvious, but the important question is, why would such opportunities exist? Because markets are filled with people who are not optimizing for price. They're optimizing for something else. Sometimes they need liquidity. Sometimes they need to reduce risk. Sometimes they're constrained by regulations. Sometimes they're managing client flows. Sometimes they're simply trying to survive. In other words, many participants are not trying to maximize profit on every transaction. They have other objectives. And that's where opportunity comes from. The amateur imagines markets as a giant IQ competition. The professional understands that markets are largely about incentives. If you understand incentives, you start seeing opportunities everywhere. If you ignore incentives, you are left trying to predict prices, and prediction is usually the hardest part of the game. Here's another idea that confuses beginners. They think risk is something to eliminate. But if you eliminate all risk, you eliminate all return. Risk isn't the enemy. Uncompensated risk is the enemy. There's a huge difference. A business owner accepts risk, an investor accepts risk, an entrepreneur accepts risk. Nobody gets paid without it. The question is whether the reward justifies the exposure. Every profitable activity contains uncertainty. That's precisely why it pays. If there were no uncertainty, competition would destroy the opportunity. This is one of the most important principles in finance. The reason opportunities exist is because many people are unwilling or unable to tolerate certain risks. When you can tolerate those risks intelligently, you get paid. When you take risks blindly, you eventually disappear. The goal isn't courage, the goal is selectivity. Take risks that pay, avoid risks that don't. Simple, not easy, but simple. Now we arrive at the issue that destroys most trading strategies: competition. People love talking about opportunities. Very few people talk about competition, but competition determines almost everything. Suppose I show you a strategy that is easy, safe, highly profitable, requires almost no work, and scales indefinitely. What's going to happen? Everyone will do it. The opportunity disappears. The very fact that an opportunity exists usually means something about it is unattractive. Maybe it's difficult. Maybe it's uncomfortable. Maybe it requires patience. Maybe it involves uncertainty. Maybe it's labor intensive. Maybe it's small. Maybe it's psychologically unpleasant. There must be a reason other people aren't rushing toward it. And that reason is often why the edge lives. Whenever you discover a potential opportunity, ask yourself, what is bad about this? What is inconvenient about this? What causes other people to avoid it? If you can't identify the answer, you may not have found an opportunity at all. You may simply be standing in a crowded trade, and crowded trades have a habit of ending badly. One of the most expensive habits in finance is trying to beat people at their own game. Think about who you're competing against: large institutions, quantitative funds, market makers, specialists, people with enormous resources, people who spend every waking hour doing this. Trying to defeat them in the areas where they are strongest is not a strategy. It's an act of generosity. You're donating money. The intelligent approach is different. Find areas where competition is weaker. Find situations others cannot participate in. Find risks others cannot tolerate. Find work others don't want to do. Find opportunities too small for large players to care about. Find niches. Find friction. Find neglected corners. The goal isn't to be smarter than everyone. The goal is to avoid competing with everyone. That distinction alone can transform an entire career. People often imagine edge as secret knowledge. It usually isn't. Real edge often comes from structure. Patience is an edge. Discipline is an edge. Long-term horizons are an edge. Liquidity can be an edge. Flexibility can be an edge. The ability to tolerate uncertainty can be an edge. The willingness to do unglamorous work can be an edge. Notice something. None of these require predicting the future. They require positioning yourself intelligently in the present. That's a very different mindset. One is about being right, the other is about being robust. Being right occasionally can make money. Being robust consistently keeps money. And the second is far more important. The biggest illusion in markets is the belief that intelligence alone produces results. It doesn't. If it did, professors would dominate the investment world. Many don't. Knowledge matters. But incentives matter more. Structure matters more. Positioning matters more. Risk management matters more. You can have a brilliant prediction and still lose money. You can have an average prediction and make money, because outcomes are determined by far more than forecasts. This is why successful traders often sound boring. They're talking about sizing, risk, competition, process, patience. Meanwhile, unsuccessful traders are usually discussing predictions. One group is building a business, the other is buying lottery tickets with extra steps. So, if you're serious about making money in markets, start with a simple question: why should I earn a return? Not because you're smart, not because you found a chart pattern, not because you watched enough financial news. Why should money flow to you? What risk are you accepting? What service are you providing? What competition are you avoiding? What advantage you actually possess? Because trading is not a magic trick, it's not a forecasting contest, and it's certainly not a search for secret knowledge. It's a business built around finding situations where you can buy cheap, sell rich, accept the right risks, and avoid unnecessary competition. Everything else is mostly entertainment, and entertainment is often very expensive. If you found this useful, subscribe to the channel. In future videos, we'll go deeper into where opportunities actually come from, how risk creates return, and why most market advice fails precisely because it ignores incentives. Until then, remember, the objective is not to predict the future, the objective is to survive it.